So the Fed's in a tough spot. They want to make sure we don't get into a place where we have a lot of people getting out of jobs, being laid off, and having larger unemployment. But at the same time, they don't want to cause inflation to get out of control. So they are in a very difficult moment. How do you thread that needle? Welcome to Life in the Markets. My name's Tim Russell, and today is Monday, August 25th, 2025. I cannot believe that the summer is just about over. Kids today are going back to school. I passed a number of school buses on my way. I know some of you, that's old news. Kids have been back in school for a while, but it's new around here. So, we're certainly enjoying the end of summer, slower season. A lot of people on vacation now. Some people getting back to work, getting kids back to school. It's always an interesting time of year. It's also an interesting time of year with the markets. And if you looked at the stock market last week, if you would have missed Friday, if you would have just paid attention Monday through Thursday, you would have probably thought, wow, it's a lousy week for the stock market. And it was, by and large, pretty lousy. Every single day, the stock market, the S&P 500, the Dow Jones Industrial Average, certainly the NASDAQ, traded lower. Now, interestingly, we ended the week largely positive. So what generally happened was that the week was very much anticipating a speech that Jerome Powell, the chairman of the Federal Reserve, was going to provide to the markets or to the nation on Friday morning. And when that speech came out, the markets paid very close attention to every single word he said. And I'll get a little bit into more about what he said later, but largely the markets were encouraged by what he said. And we saw one of the biggest rallies this year. Here on Friday, the stock market responded overwhelmingly positive. So where does that leave us at the end of a week? After a largely negative week, we actually were in a spot where we had a generally positive outlook for stocks and the economy. Okay, the trend which we talked about last week, so the trend for smaller companies outperforming larger companies, that continued. So among the leaders this week was the small cap weighted Russell 2000. The Russell 2000 did very well. It was up 3.6% in the last 5 days. A lot of that came just there on Friday. The S&P 500, 500 biggest companies in the country and the world, frankly, that was up only 0.4%, just under 0.4%. The NASDAQ, that was actually down this week. It was down basically 0.8%, so a little less than 1% down for the week. Certainly not carnage, not the end of the world, but it's very interesting that what we're seeing this past week is that this profit taking from these very large tech-oriented companies whose prices have gone up so high, and we've been talking about this over the last several weeks, you have to be cautious when the price relative to the profit of those companies has become so disjointed that you get to a place where there's concern about the economy, there's concern about what the Fed's going to do. It's very common to see profit taking in some of those large numbers. But what we are seeing is some of the smaller sized companies, the medium to smaller sized companies actually performed well, which to me indicates a shift from growth to value and from large to smaller companies, which is an overwhelmingly good thing, I believe, for the health of our economy in general, that our medium to smaller size companies are actually now starting to be rewarded for the work that they're doing and the value they provide to our economy. Other things of note, we have gold and oil were both up 1% for gold, 2.5% for oil, and cryptocurrencies like Bitcoin, they were largely flat this week. Let's talk about earnings. Last week, we said there were a number of interesting earnings reports, some of them going to tell us a little bit of a glimpse into the health of the American consumer. And yes, we got that. We also, obviously, it's an earnings report for a very particular company, and we got to see how each individual company is dealing with the nuances of the American consumer. So we're seeing that Home Depot and Lowe's, they generally had very positive reports. And what they're doing and what they're seeing is that there is cost and price pressure, that consumer behavior is shifting a little bit in terms of the kinds of things that they're purchasing and what they're doing with their money. In some ways, it's actually good for a place like Home Depot and Lowe's. For things like Walmart and Target, that was really interesting because it was kind of a tale of two cities. We have Walmart, which is a famed discount reseller. They're famed for having their low prices, and they saw a very good earnings report. The profits were up, revenues were up. They're being able to absorb or have their consumers absorb much of the inflationary costs that Walmart is experiencing, and doing it in a way that's not discouraging people from purchasing at Walmart. Whereas the other retailer, Target, after facing all of the backlash for their absolute stupidity over Gay Pride Month and some of the other things that they've done historically, they've just been like, shoot yourself in the foot and blame someone else for it, go for it. They also have been facing real price pressures because many of their consumers, if they're not fed up with their politics, they're fed up with the prices. The prices at Target have continued to go higher, and we're seeing a lot of the higher income individuals who would normally shop at Target are choosing to do some of that shopping at Walmart. And that's actually something that we've been noting over the last few earnings reports. Walmart indicates that the highest growth segment of their consumer base is of individuals making more than $100,000 a year. Isn't that interesting? So while we are seeing some inflationary pressures on consumers are still willing to spend, but they're going to be more discriminating about the stores in which they spend that money. We have a number of earnings reports coming up this week. NVIDIA, one of the biggest companies, I think it is the biggest company in the world right now. It's a $4.3 trillion. Just wrap your mind around that one. The chip manufacturer is going to be releasing earnings. We've got a number of other ones, CrowdStrike, Dell, Snowflake. A lot of interesting things to come out. A lot in the tech space coming out this week, which I'll be very interested to see what's happening within those companies as they deal with tariff issues and concerns, pressures about what they can sell or can't sell to China. That's very specifically to NVIDIA right now. So we'll pay attention and hopefully be able to give you some more information as that comes out throughout the week. So right now, as we kind of wrap up the commentary for this week's podcast, we're seeing that the Fed is in a very tough spot. The Federal Reserve, last week we said Jerome Powell gave this speech at Jackson Hole, Wyoming, where he indicated that at this point, concerns about employment is outweighing concerns about inflation. What that means is that they want to make sure, or they frankly, they see the bigger risk to the economy right now is increasing unemployment, whereas the concerns about inflation, while they're still there, they're not quite as high or as dire in perhaps as dire is the wrong term, but you get the idea. Not as large a concern as unemployment. So when the Fed said that, when Jerome Powell said that we care about what happens with employment and that we're ready to take steps as necessary, that was code to the markets that, our prediction that the Fed would cut rates is likely to be the case. Now, I feel like at this point we need to do a little bit of Fed 101. The Fed has a mandate. It's actually got a dual mandate. It's got to do two things. It needs to focus on maintaining or achieving full employment while maintaining price stability. In English, what that means is, hey, we want to make sure that the economic conditions where a company would be forced to lay off employees, we avoid that. We want to avoid large layoffs, large unemployment. At the same time, we want to make sure that we manage inflation and the costs going up over time, because if we have inflation that gets out of control, that's going to be a bad thing for our economy. Now, one of the most important tools that the Fed has in its toolbox to address both of these dynamics is interest rates. The federal funds rate. Now, what is the federal funds rate? The federal funds rate is the government sets, or the Fed sets the rate at which banks lend other banks money for short-term overnight loans. So this is very common. It happens all the time within the banking world. We have a fractional reserve currency, which essentially means that if you deposit at the bank $1,000, you have $1,000 that's available anytime you want it. But at the same time, they're allowed to take $900 of your dollars and lend it out to someone's mortgage or a car or a credit card, and they can make interest on that money. Now, what happens if you want your $1,000 back? 900 of it is out in loans. So what the bank does is goes to other banks and says, hey, I just have a short-term credit or need for some cash. Let's do some swapping. They'll get some short-term money to make sure you are whole while they're still collecting money from other sources. It's a very common thing. Maybe you're comfortable with that. Maybe you're not. I'm not thrilled with it, but I understand it. That rate is a really important rate, and that rate influences a lot of things that happen in the economy. Now, here's the way it works. If the Fed wants to encourage risk-seeking or risk-taking behavior, growth and expansionary behavior, it can lower that rate, the federal funds rate. Now, remember, it's not just that rate affects the rates that banks charge other banks. That rate then has large ripple effects within the broader economy. Many business loans are set on that rate or a rate that's based on that rate. And many other loans and other interest rates are affected by that. So when it changes and lowers that interest rate, the cost to borrow money goes down. The interest rate on money in cash savings goes down. So you're encouraged to take the money that you're not earning much on and take more risk with it in order to get a better return. So you're encouraging risk-seeking behavior, which is expansionary towards our economy, which tends to encourage employment. Do you see how that works? When we lower interest rates, we're encouraging growth of businesses, growth of employee payrolls, which is good for our economy. Now, here's the negative. As the economy tends to heat up, what happens? Well, inflation, the cost of prices, the cost of goods goes higher. And remember, the Fed has a dual mandate. Not only do we have to worry about making sure employment is strong, we also have to make sure that prices are low or at least stable. And when we get to a place where they're pushing the one, employment, they're going to cause a problem on the other. They pull on the one, they tug on the other. So now inflation could become an issue. And as inflation starts to heat up, what is the Fed going to do? It's going to increase the federal funds rate, which tends to increase risk avoidance behaviors, increase savings, and make the cost of borrowing money higher. Therefore, the economy is generally going to cool a little bit, helping to tamp down the negative effects of inflation. Now, here's why I say the Fed's in a tough spot. The Fed's in a tough spot because by every objective measure, okay, maybe not every, but by many objective measures, our economy is actually pretty strong. We've got, I know the stock market is not the economy, but let's look at the stock market, for example. We're at or near all-time highs. We have consumer sentiment still largely really strong. We have a growing economy. The earnings reports that we've had, we're in the middle of it right now. We're kind of getting towards the end of it. And this earnings report has been, by every measure, one of the most successful earnings seasons that we've had in recent memory. And all of that tells us that the strength of the American economy, the strength of the American consumer is still robust. So if we're going to lower interest rates because there is concern about employment. I said not every measure, right, says the economy's fine. One of the ones they're concerned about is inflation, the jobs numbers. We saw the unemployment rate tick higher a few weeks ago. The Fed is going to try to combat that. They think that is a bigger risk than rising inflation. But we haven't yet booked all of the price impacts of tariffs. So the Fed's in a tough spot. They want to make sure we don't get into a place where we have a lot of people getting out of jobs, being laid off, and having larger unemployment. But at the same time, they don't want to cause inflation to get out of control. So they are in a very difficult moment. How do you thread that needle? They're walking a very fine line. So how is this all going to play out? I don't know. I don't know how it's going to work within the economy, but I can tell you I'm going to be watching it very closely. We'll be reporting on it here at the Life in the Markets podcast. So stay tuned and follow us as we kind of watch how the economy deals with the Fed's mandate and what the Fed does with protecting employment and protecting against inflation. All right, I hope that was helpful for you as we move towards some more updates for the company. Just a few things I wanted to note as we transition into the end of the summer. This week, we have a few things coming up in the life of our company that I want you to know about. Number one is that on Tuesday afternoon and Wednesday morning, we're going to have a skeleton crew here at the Life Group. We have a special class that's taking place not too far from our office that many of our office is going to be able to learn, to grow, and to improve our own understanding and our ability to advise Christians on investments and try to help people make wise choices with their money. So if you do have a need or a need to reach out and talk with one of our team members, just be aware that we may have a later staff. Calls may ring a couple more times than they would otherwise ring. I apologize for that. Just be aware in advance. We also have a staff event on Friday. We'll be closing down the office just a little early, 3:30, 4 o'clock. So shouldn't affect too many of you, but we're getting together at my house. We're going to have a great time celebrating the end of summer and the beginning of the new fall season, which is always busy for us here at the Life Group. If I could just give you one more update, we're a Christian organization, and one of the things that means is that we have weekly prayer and devos. So number one, if you have a prayer concern, if you have a prayer request, email us at contact@thelifegroup.org and share your prayer concern with us, because we will remember to pray for you on Wednesday mornings as we gather together as a staff. And if you don't want to email the contact, you can email your direct advisor or paraplanner or other contact here at the Life Group, and we'll be sure to get that shared to the team. The other thing to note is that we have a human call system. You call in, a human being answers the phone, except for when we're in prayer. Because we want to pull our staff together to take advantage of that time. So if you do call on Wednesday morning between 9 and 10 and you don't get anyone, it's because we're meeting for devos. So just be aware of that in the life and rhythms of your week and our week here at the Life Financial Group. So as we close today, I want to share a verse from Proverbs 22, verse 9. This verse says this: "Whoever has a bountiful eye will be blessed, for he shares his bread with the poor." Proverbs 22, verse 9. What does it mean to have a bountiful eye? Largely, it says those who are generous are blessed because they share their bread with the poor. One of the most important things that we're called to do as Christians in terms of our testimony to the world is to care about those who are suffering, those who are poor. The Lord said, the poor you will always have with you. I will not always be with you. He said, pay attention to me. So yes, pay attention to Jesus, but don't neglect the reality of the poor. So today, as you think about your life, your giving goals and your generosity, I would encourage you to remember to be generous with those who are in need. Do not close your ears to the cries of the poor. The Lord will bless. I hope you're doing well. I hope you have a wonderful week. We'll see you back here possibly next week. I should actually make a note. Next week is Labor Day, so we won't have the regular episode coming out on Monday. Take care. God bless. See you later.
The topics discussed in this podcast are for general information only and are not intended to provide specific investment advice or recommendations. Investing and investment strategies involve risk, including the potential loss of principal. Past performance is not a guarantee of future results. All information herein is from sources believed reliable, but is not guaranteed for accuracy or completeness. The team assumes no liability for any errors, omissions, or actions taken based on this material. Information is as of the date stated and subject to change without notice. Securities and advisory services offered through Genius Wealth Management. Member FINRA and SIPC.